If you own a home or are thinking of buying one, you know that property taxes come with the territory. They're a part of home ownership that you can't ignore. So it's best to understand them. In the next few minutes, we'll break down what property taxes are, how they're calculated, ways you might save a bit of money on them, common mistakes to avoid, and even some Bay Area specific insights like the scoop on Proposition 13 and those mysterious Mello-Roos taxes. By the end of this episode, you'll have a clearer picture of property taxes and how to handle them confidently. So grab a cup of coffee and let's get started. Welcome to the Bay Area Real Estate Podcast. I'm your host, Harv Balu, with Realty Experts in Fremont, here to provide you with the real insights, trends, and solution for the Bay Area real estate market. From market updates to expert tips for buyers and sellers, we got you covered. Whether you are in Milpitas, Fremont, San Jose, or anywhere nearby, this podcast is your go-to resource for making smart and informed real estate decisions. Let's make your real estate journey smooth and successful together. For more information, visit my website at realtorharvinder.com. All right, now let's dive into today's episode. And today we're diving into a topic that isn't glamorous, but is absolutely essential for homeowners and real estate investors: property taxes. All right, first things first, what exactly are property taxes? In simple terms, property taxes are an annual tax that local governments charge on real estate that you own. If you own a house or a condo or any piece of land with or without a structure, you'll pay property tax on it. These taxes are usually based on the value of your property. The idea is that if you have a more valuable property, you contribute a bit more to the community. Why do property taxes exist, and where does that money go? Property taxes fund all sorts of important local services and infrastructure. We're talking about schools, road maintenance, parks, police and fire departments, and other community needs. So when you pay your property tax bill, that money helps keep the street lights on, pays teachers and first responders, fixes potholes, and maintains the library. All the stuff that makes your neighborhood a nice place to live. One important thing to note is that property tax rates vary by location. Every city or county can have a different rate. Here in the Bay Area, rates can differ a bit from county to county, and we'll get into specifics later on. But no matter where you are, property taxes are just a reality of owning real estate in the U.S. Think of it as part of the cost of owning a home, just like maintenance or insurance. The key is to understand how it works so you're not caught off guard. How are property taxes calculated? Now that we know what property taxes are, you might be wondering, how do they figure out how much I pay? Great question. It comes down to a simple formula, in theory at least: assessed value of your property times the tax rate, sometimes called a millage rate, minus any exemptions, equals your property tax bill. Assessed value. This is not always the same as market value. The assessed value is the value the local tax assessor assigns to your property for tax purposes. It's often a percentage of your market value or based on your purchase price, depending on local rules. For example, if you just bought a home for $800,000, the assessor might use that as the new assessed value. In some places, assessed value is updated periodically based on market trends or improvements you've made to the property. Tax rate. Millage rate. This is the percentage of the assessed value that you'll pay in taxes. It's often expressed in terms of mills, where 1 mill equals $1 in tax for every $1,000 of assessed value. For simplicity, let's use a percentage. Many areas in California have a base property tax rate of 1% of the assessed value, thanks to state law. More on that in the Bay Area section. Plus, there can be small add-ons for local bonds or special fees. So if your local tax rate is, say, 1.2%, that means you pay 1.2% of your property's assessed value in taxes each year. Exemptions, deductions, these are basically discounts on your assessed value that reduce your tax. Not everyone gets them, but common ones include a homestead exemption for primary residents or exemptions for seniors, veterans, etc. We'll talk more about these in a minute. Let's do a quick example to make it real. Suppose your home's assessed value is $500,000. Maybe you bought it for that, or that's what the county thinks it's worth for tax purposes. And the property tax rate is 1%. 1% of $500,000 is $5,000. So you'd owe $5,000 in property taxes for the year. If the rate is 1.2%, you'd owe $6,000. Now, $500,000 is a pretty modest home price for the Bay Area. So if we imagine a $1 million assessed value at 1.2%, that'd be $12,000 a year in taxes. Yes, living in the Bay Area isn't cheap. The key point is that higher assessed value or higher tax rate equals higher taxes. Local governments set the tax rate and they assess your property's value. These are two factors determine your bill. Every year or however often your area reassesses property, you might see a change in your assessed value or the tax rate, which means your tax bill can change too. Nobody wants to pay more taxes than necessary, right? The good news is there are often legal ways to reduce your property tax bill through various programs and strategies. Here are a few to look into. Oh, before we move on, just a reminder that I am a real estate expert, but I am not a CPA, tax attorney, or professional tax advisor. The information I'm providing today is based on general knowledge and should not be considered official tax advice. If you have specific questions about your situation, please consult a qualified tax professional or attorney. Now that's out of the way, let's move on. Homestead exemption. If the home is your primary residence, meaning you live there most of the year, you might qualify for homestead exemption. This usually knocks a certain amount off the assessed value that is taxed. For example, California offers a small homeowner's exemption around $7,000 off your assessed value for primary home. It's not huge. In California, that might save you about $70 a year. Hey, that's a nice dinner out. Other states have larger homestead exemptions, so it depends where you are. It's worth filing for it if you're eligible, because why not save a bit of money each year? Senior, veteran, and other special exemptions. Many areas have tax relief programs for certain groups. If you're a senior citizen, a disabled homeowner, or a military veteran or surviving spouse, you should check what your county offers. You might get a percentage off your tax, a freeze on your assessed value, or some other break. For example, some California counties allow seniors to defer taxes or transfer a low tax base to a new home. Proposition 19, for those curious, lets homeowners over 55 move and keep their lower tax assessment in some cases. Each program has different rules, but these can significantly reduce your tax burden if you qualify. Side note, I just attended a class on Proposition 19 today, and it was very interesting. I might do a podcast on it as well to share what I've learned. Let's keep going. Appealing your assessment challenges. One strategy to save money is to make sure your assessed value isn't overstated. Sometimes assessors value your home too high, which means you're paying too much tax. As a homeowner, you have the right to appeal or challenge your property assessment. If you genuinely believe your home would not sell for the value the county thinks it's worth, you can gather evidence like recent sales of similar homes and file an appeal. There's usually a time window each year to do this. It might require a bit of paperwork and maybe a hearing, but if you succeed, your assessed value is lowered and so are your taxes. It's a perfectly legal and common way to ensure fairness. A quick tip: always read your property assessment notice when it comes in. Don't just file it away. If the value jumped way up and it doesn't make sense, look into it. Often there's an appeals board or local assessor's office that can guide you on how to contest it. Worst case, they say no, and you're where you started. Best case, you save money each year going forward. Property taxes can be confusing, and it's easy to slip up. Let's go over a few common mistakes homeowners make with property taxes so you can avoid them. Ignoring reassessment notices or deadlines. One mistake is ignoring that letter from the assessor's office. Each time your property is reassessed, valued for tax purposes, you usually get a notice. If you don't agree with the new assessed value, there's a short window to appeal. Many people toss the letter aside and later realize they missed the chance to challenge a high valuation. The fix: always open mail from the county tax assessor and mark your calendar for any appeal deadline. Not budgeting for tax increases. Property taxes aren't a static bill. They can go up or down, but usually up over the long run. A big mistake, especially for new homeowners, is not budgeting for future tax changes. For example, if your city passes a new school bond, your tax rate might increase slightly. Or if you improve your home, say add a big family room or a new ADU, the assessed value might go up and so will your taxes. In the Bay Area, thanks to Prop 13, which we'll discuss soon, annual increases in assessed value are limited. But if you just bought a home, your base assessment might be much higher than what the previous owner had. Don't assume you'll pay what the last owner paid. That bill can reset when you purchase. The key is to plan ahead. Set aside a bit for taxes each year, and if you hear about local measures that might raise taxes, factor that in. Misunderstanding escrow accounts. If you have a mortgage, there's a good chance your lender set up an escrow account for your property taxes and home insurance. This means a portion of your monthly mortgage payment goes into a little savings pot to pay the tax bill when it's due. A common mistake is thinking, oh, my bank is handling it. I don't need to think about property taxes. In reality, you should still keep track. Why? Because if your taxes go up, your escrow might not have enough, and your lender will then bump up your monthly payment to make up the difference. That can be a nasty surprise. Also, sometimes lenders make mistakes or payments get misapplied, and you don't want to find out you owe a late penalty because you assumed the bank paid on time. So even with escrow, note the due dates and amounts. And if you pay taxes on your own, not through escrow, be vigilant about paying by the deadline. Typically, semi-annually in California, for example. Missing a property tax payment can lead to penalties or even a lien on your home. So put those due dates on your calendar. In short, stay informed and proactive with your property taxes. A little attention can save you money and stress down the road. Now, let's talk about some Bay Area specifics. Property taxes here follow the general principles we've discussed, but there are a few local twists you should know about. First, Proposition 13, the 1% rule and why your neighbor's tax bill is different. If you've lived in California for a while, you've probably heard of Prop 13, passed in 1978. Proposition 13 is a California law that basically limits property tax rates and limits how much your assessed value can go up each year. Under Proposition 13, the base property tax rate is capped at 1% of the assessed value. Local voters can approve additional taxes for things like school bonds, infrastructure, etc. But even with those, most Bay Area property tax rates end up around 1.1% to 1.2% of assessed value. Another big thing Prop 13 does, it limits increases in assessed value to no more than 2% per year as long as you own the property. That means if you've owned your home for 20 years, your tax assessed value might be way below the current market value. This keeps your tax bill relatively low and predictable over time, which is great for long-term owners. You won't get taxed out of your home just because market prices skyrocketed around you. However, when a property changes ownership, like when you buy a new house, the county will reassess it at the current market value, essentially the purchase price. That becomes the new baseline. So in the Bay Area, it's common for a recent buyer and a longtime neighbor with a similar house to have very different tax bills. The Prop 13 benefits the person who stayed put a long time. If you're the new buyer, just be aware you'll be paying based on that full market price you paid. But at least you know it won't jump more than 2% a year going forward. There are some exceptions, like if you do major new construction or if there's a partial change in ownership. But that's the general idea. 2. Differences across Bay Area counties. All California counties follow Proposition 13, so they all have that 1% base rate, but the total property tax rate can vary slightly by county and city because of different voter-approved add-ons. For instance, one county might have more school bonds or special district taxes than another. As a result, you might see effective rates like 1.25% in one city and 1.10% in another. San Francisco and San Mateo counties historically have slightly lower effective rates on average, maybe around 1% or a tad above, because property values are so high and many longtime owners keep the averages down. Contra Costa or Alameda might be a bit higher, closer to 1.2%, due to various local measures. These numbers change over time with new bonds and such, but the point is check the local rate for the specific area you're interested in. Your real estate agent can help, or you can look on the county tax assessor/treasurer's website. It's usually public information. The differences aren't gigantic, but in the Bay Area, even a 0.1% difference matters when home prices are high. 3. Mello-Roos and special assessments. Don't be thrown off by the funny name. Mello-Roos rhymes with yellow juice, sort of, refers to special tax districts created to fund infrastructure in new developments. In some newer communities, think of subdivisions built in the 80s, 90s, or 2000s, often in places that were more recently developed. Developers and local governments set up these community facilities districts. They sell bonds to build things like new schools, roads, sewer systems, parks, all the stuff needed for a new neighborhood, and then homeowners in that area pay an extra tax, the Mello-Roos fee, to pay off those bonds, usually over a few decades. If you buy a home in such an area, the Mello-Roos fee appears as a separate line item on your property tax bill. In addition to the 1% base tax, it can be a significant amount, sometimes a few $100s a month equivalent. The good news, Mello-Roos taxes are not forever. They expire once the bonds are paid, commonly after 20 to 40 years. The bad news, you could be on the hook for them for a long time if the bonds were recently issued. Always ask if a home has Mello-Roos or other special assessments. In the Bay Area, you'll see this in parts of places like Dublin, Mountain House, newer San Jose developments, and so on. It doesn't mean those homes are bad. New infrastructure is nice, but you want to budget for that extra tax. Apart from Mello-Roos, there can be other special assessments or parcel taxes. For example, some cities or school districts have flat rate parcel taxes, like a fixed $300 per parcel for school funding, regardless of value. These also show up on the tax bill. The bottom line is, especially in the Bay Area, read the fine print on any property's tax bill so you know all the components of what you will pay. Once again, I am a real estate expert, but I am not a CPA tax attorney or professional tax advisor. The information I am providing today is based on general knowledge and should not be considered official tax advice. If you have specific questions about your situation, please consult a qualified tax professional or attorney. Thank you so much for hanging out with me today and talking about property taxes. I know it's a dense topic, so kudos to you for sticking with it. Understanding property taxes is a big part of being an informed homeowner or investor, especially here in the Bay Area. If you found this information useful or if it sparked more questions, I invite you to reach out and continue the conversation. Don't forget to subscribe to the Bay Area Realty Experts podcast so you never miss an episode. We cover lots of helpful topics like this to make your real estate journey easier and more understandable. If you enjoyed today's episode, please consider leaving a rating or review. It helps others find our show. Thanks again for listening. Until next time, happy house hunting, happy investing, and take care.